The following is the summarized balance sheet of Royal Blue Limited. Liability side, 6,008% redeemable preference shares of 100 each, 6 lakhs. 3,009% redeemable preference shares of 100 each, rupees 75 paid up, 2,25,000. 1,50,000 equity shares of 10 each, fully paid, 15 lakhs. Capital reserve 1 lakh. Securities premium 60,000. Revenue reserve 6 lakhs. Other liabilities 3 lakh 60,000. Assets side, sundry assets 26 lakhs 20,000. Cash at bank 8 lakh 25,000. Balance sheet total 34 lakhs 45,000. It was decided to redeem both the classes of preference shares at a premium of 5%. The company issued for cash so many equity shares of rupees 10 each at a premium of 10% as were necessary to provide for redemption of both classes of preference shares which could not be otherwise be redeemed. The issue was fully subscribed and all the monies were received. Then the company made a bonus issue for 1 share for every 3 shares for existing equity shareholders. Pass journal entries and redraft the balance sheet. In this problem, there are two classes of preference shares. One fully paid, that is 6,000 shares, that is 100 each fully paid. Second variety of preference shares are 100 each, but only 75 paid up. As we have learned in our legal provisions, partly paid up preference shares cannot be redeemed. That should be made fully paid up first, then only it can be redeemed. So, first we have to write journal entry for making call on that unpaid amount of that particular class of preference shares. So, here journal entries in the books of Royal Blue Limited. Before starting journal entries, let us go for the calculation, because without calculation journal entries cannot be written. So, as it is given in the problem, equity shares are issued. How many equity shares are issued? Not given. So, let us find out the number of equity shares to be issued to redeem both the variety of shares. Of course, we are redeeming both the classes of preference shares. So, calculation of number of shares to be issued. Let us find out first what is the total amount required to redeem both the classes of preference shares. So, first variety of preference shares total nominal value is 6 lakhs. Second variety of preference shares actually as per balance sheet is 2 lakh 25, because it is only 75 paid up. When it becomes fully paid up, when 3,000 shares of 100 each, then it will be 3,000 into 100, that becomes 3 lakhs. As I said, unpaid amount should be called and that 75 paid up should be made 100. Then that value of the preference shares becomes 3,000 into 100, 3 lakhs. So 6 lakhs plus 3 lakhs, totally 9 lakhs we need. But actually a divisible profit available is only revenue reserve 6 lakhs. 6 lakhs revenue reserve we have, that we can utilize for redemption of preference shares. So remaining amount 3 lakhs rupees we have to arrange by issue of fresh equity shares. So let us find out how many equity shares are required. 3 lakh rupees required. The number of shares, the face value of the new shares issued is 10. So 3 lakh divided by 10, 30,000 shares we have to issue. So what is the total premium we have to pay at the time of redemption of preference shares is the preference shares are redeemed at a premium of 5%. So 5% and total 9 lakh is the total amount of redemption of preference shares, 9 lakh. On that 5% that comes to 45,000. So 45,000 premium we have to pay at the time of redemption of preference shares. 30,000 shares we have calculated. Premium of redemption preference share we have calculated. Next, let us see the new point which is given in this problem is about bonus shares. Here, bonus shares are issued for the existing shareholders at the ratio of 1:3. For every 3 shares, 1 share is issued. So, the proportion is like that. 1 bonus share for 3 shares. So actually that is only for the existing equity shares, not for the fresh issues. How many existing equity shares we have in as per balance sheet? 1,50,000 equity shares we have. So we have to issue now a bonus shares for 1,50,000 equity shares. When we cross multiply 1,50,000 divided by 3, that gives you 50,000 shares. So we have to issue 50,000 bonus shares to the existing equity shareholders. That is the extra point which is given in this problem. Okay, that the issue of bonus shares comes at the end of the journal entries. Now let us start the journal entries. We have 5 columns: date column, particular column, ledger folio, debit and credit. So here for calling the unpaid amount and the receiving of amount, separate entries are written. In the previous problem, it is only one entry, clubbed entry written, that is bank account debtor to preference share capital account, one entry. Here two entries are written. Either you can write one entry, combined one entry for collecting money on final call, or otherwise you can write two entries by writing first entry for making call and second entry for receiving money. Both are right. One entry or two entries, both are right, but the entry should be correct. So here two entries are written: 9% preference share final call account debtor to 9% preference share capital account. How much is the unpaid amount? 75 paid, 25 is unpaid. 25 into 3,000. Number of shares 3,000 into 25. 75,000 is the final call made. Now next entry for the final call money received. That is when money is received, bank account debtor to 9% preference share final call account, that is 75,000. Instead of these two, we can write bank account debtor to 9% preference share capital account 75,000. That is also right. One entry instead of two entries, that is also right. So third entry for new issue, fresh issue of equity shares. When we issue shares, bank account is debtor because we are receiving money. So bank account debtor to equity share capital to securities premium, because the fresh issues are made at a premium of 10%. So how many shares we are issuing? 30,000 shares at the rate of 10. So 3 lakh. Security premium is 10% of that is equal to 30,000. So total bank is 3,30,000 being fresh issue of shares made. Second, transferring the divisible profit to capital redemption reserve. How much we are transferring? 6 lakhs. Amount available, see the working note, 6 lakhs. So revenue reserve account debtor to capital redemption reserve account, 6 lakh being the transfer of money divisible profit from revenue reserve to CRR. Next, provision for premium on redemption. Securities premium, we already in balance sheet we have 60,000. So that is sufficient for the premium on redemption. We need 45,000 premium on redemption of preference shares. We have 60,000 in securities premium account. So sufficient it is. So we can transfer from securities premium to premium on redemption 45,000 without any problem. So securities premium account debtor to premium on redemption account, that is 45,000. That is being transfer of amount from securities premium to premium on redemption account. Next, sixth one, due entry, premium due entry. Now we are arranging the money to pay at the time of redemption. There are two variety of preference shares. One is 8% preference share, another one is 9% preference shares. So we'll make it together and we'll pay it together. 8% redeemable preference shares account debtor 6 lakhs, 9% redeemable preference shares account debtor 3 lakhs. Premium on redemption of preference shares is 45,000, that is 5% on 9 lakh. To preference share capital account 9,45,000 being amount due is transferred to preference shareholders account. Next one, payment. These are the last two entries always we write in our redemption of preference procedure. Preference shareholders account debtor to bank account being preference shareholders paid 9,45,000, 9,45,000. Now the extra entry what we have here, that is bonus share. How much? 50,000 shares of 10 each bonus shares we are issuing. So first we have to transfer sufficient money from CRR account to bonus to shareholders. So CRR account debtor 5 lakhs to CRR account we can write, or capital reserve account we can write, to bonus to equity shareholders 5 lakhs being bonus issue is made. Next, we'll transfer that to equity share capital account. Bonus to equity shareholders account debtor to equity share capital account 50,000 into 10. The same amount we are transferring to bonus shares are allotted to the existing equity shareholders. Now let us go for the new balance sheet, that is redrafted balance sheet after redemption. Liability side. First we write equity share capital. Now we have to be very careful. Existing equity shares we have 1,50,000. After that, what is the 5 lakh value of bonus share plus 3 lakh new shares issued for the redemption? That is how much? 3 lakh. So 15 lakhs plus 5 lakhs plus 3 lakh. 23 lakhs is the equity share capital. Then CRR account, cap redemption reserve. 1 lakh rupees capital reserve we have. Then 6 lakh we have transferred for the redemption of preference shares. Then 5 lakh we have given from CRR to bonus shares. So that 5 lakh we have to deduct. Together 2 lakh is the balance. Next, securities premium account. Securities premium account, see the previous balance sheet. There we have 60,000 balance securities premium we have, and by issue of new shares we got 30,000. 60,000 plus 30,000 minus 45,000 is the premium we paid on redemption. So 60,000 plus 30,000 minus 45,000, total 45,000. Next, other liabilities, that is as per the previous balance sheet. 3,60,000 no change. Sundry assets no change. Bank we have to see all the journal entries. Where we have written bank, that we have to, where you have written debit bank, that will be added. Where we have written credit bank, that will be deducted. So one debit bank we have 75,000, that is a second journal entry. Second bank we have third journal entry, that is 3,35,000. Then where we have bank account, over two bank account, one is 75,000 second entry, one is 3,30,000 third entry, and the balance already which we have in our balance sheet, previous balance sheet, cash at bank 8,25,000. So 8,25,000 plus 75,000 plus 3,30,000 and one bank credit, that is seventh entry. Seventh entry, preference shareholders account added to bank account 9,45,000, that is paid. So paid means minus 9,45,000 minus. So 2,85,000 is the remaining cash at bank, that is written in the asset side of balance sheet. Totally 29,05,000 is the balance sheet total. That is the redrafted balance sheet.